Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the week ending December 5th, 2014. Thanks for tuning in. I've got on the screen here a weekly chart of the SPX cash index, and I thought what we would do here for this weekend is just let me give you a view of where we are, where we've been, and potentially where we're going to go over the next 90 days. I know we've had a very strong rebound from the October 15th through the early part of November pullback. And for our members, we were expecting this, and I want to just show you a couple of things here in the charts. Now, what I've got on the screen here is a weekly chart of the S&P 500 cash index, as I said, and this goes all the way back to 2009, and you can see how consistent we've been staying inside this channel, just extremely consistent. And the movement up, generally when we've hit the top part of the channel, then we come right back down to the bottom, and then we've kind of bounced off the top as we've moved up, and then we actually came down and touched the channel down here. The other thing that you can see is there's really another little channel right here, a little support line that I put in the within the channel here, but we're now hitting the top part of the channel again. Now, as you can see, again, this is a weekly chart. We can ride this channel as we did right there for about a month, and we hit a high on Friday in the SPX of about 2079.47. This blue dashed line right here is the opening price for 2014. So you can see we actually came down, touched the opening price back in early November, and then, man, we've just shot up dramatically here. And you could probably say that all the gains in the SPX was made over the past 4 weeks. 4 or 5 weeks. Just really amazing, this move up here. A lot of it is attributable to potential stimulus reaction, Bank of Japan, China interest rate reduction, and then, of course, a lot of buyers stepping in right here on this buy on the dip philosophy. I mean, that's kind of what has just permeated this market. Since we've had the QE1, QE2, and all the various stimulus that's really come forward in the market, just a lot of activity here. The other thing that I wanted to show you, as we are getting higher and higher, now you can see I've got the RSI down below, so it works on a number of different indicators, but you can see right here with the RSI, we're starting to get just a little bit of a bearish divergence. In our group, as I said in my last weekend update, we call it a bearish divergence. That would suggest that we're going to have a little bit of a pullback. Now, again, on these weekly charts, a pullback can be 1 or 2 or 3 bars, which is 2 or 3 weeks, but it doesn't suggest a severity of pullback, and it does not suggest a timing of a pullback. It just suggests we're running out of energy up here. Now, our members, we've been playing this very nicely because we've been alternating between a weekly time frame, a daily time frame, and then a really good pairing with the daily time frame would be the 2-hour time frame or the 120-minute time frame. And I'm going to show you each one of these here in just 1 minute. But I did want to show you on a weekly time frame, we're getting a little bit of a divergence set up there. You can see the RSI is well over 50. Which is a very positive indication, and we're not oversold. We're slightly below the overbought. We're slightly below the overbought area there, but it does suggest a little bit of a weakness in the markets. Now, next week is going to be a relatively quiet week for the U.S. markets. And then the week after, it's going to pick up again. We got the FOMC meeting. Everybody's going to have all eyes on just exactly what the Feds want to do in sort of a Machiavellian sort of way, which means things that tend to be naturally obvious or not, meaning we had very strong numbers on the employment numbers out of the U.S. on Friday, but the market was relatively muted. I mean, we made a new high. We didn't have to go very far to make it, but the markets were relatively muted because sometimes there's a fear that the stronger numbers is going to force up or sooner in time when the Fed's are going to raise their interest rates or start to actually start to put their foot on the brake and start to increase interest rates. So that's kind of one of the things that, I think that effect is going to be more pernicious in Q1 of next year or Q2. So this is the SPX. And if we come over and let's look at the Russell, because the Russell is a good, small cap, mid cap, risk on, risk off kind of environment. And if we look at the rut here, you can see that the channel, first of all, is a little bit wider. It goes back to 2009, the same thing here. And we're nowhere near the top in the Russell on the channel here. And that's obvious because the Russell has clearly underperformed all the other indices this year. It's just clearly underperformed. Small cap, money has not been going into small cap. You can see right here that very tight support zone, which, we momentarily went below on that pullback, but the very next day it just popped right back up. Buyers came back in. So it's still a very active support area around 1082. But you can see, again, just like the SPX, we've been riding the top and the bottom of this, and right now we're kind of in the upper third of the channel here. And the other thing is, and while we've got lower highs in the RSI, we're also making lower highs in the Russell here as well. And if I were to just kind of clear out my drawings here and show you what I mean, you can see right here, and my drawing may not be to scale, but you can see that right there. Okay, so that would tend to suggest that we're going to run into resistance right here and we'll come back down towards this area right there. All right, now that's not to say that's what's going to happen, but that's what kind of the price action seems to be indicating. And if we have a little bit of, the Russell is going to be an indicator that we want to watch very, very closely. Coming into the end of December, going into January. If the Russell starts to sell off, it's not going to be good news for all the other indices as well. All right, not going to be good news. And speaking of the other indices, if we look at the Dow, you're going to see here in the Dow, again, a very tight channel. And this goes all the way back to 2009. Now, if I were to step out in time, just so that you guys can see where these lines are drawn, you can see here this peak back over here in 1999, right at December 1999 as we were going into the dot-com bubble. Then we had another peak here right around September 2007 before we had that big pullback. And then, all of this is due to stimulus. It's just been a massive, massive amount of stimulus in the U.S. markets. And then that's been compounded by a lot of stimulus in Japan, a lot of targeted stimulus in China, and now some stimulus in the ECB. So all of that movement there, just, it's almost like a straight shot up. Why? There is no place for money to go. I've said this over and over again. The valuations in the S&P are not rich and they're not cheap. I think they're fairly valued. It's going to be more of a stock picker's market going into 2015. But there's going to be risk. There's going to be downside risk in 2015, more upside volatility risk. You can see this big movement here. And I know markets always tend to self-correct. And this market is no exception. How long can it run up? Very difficult to tell. But if you look at this indicator right here, we're getting just a little bit of bearish divergence on this one as well as we stay within this channel. Now, we had this key breakout with this what we call a upsloping trend line right here. We had that key breakout right there, and it served as support on a pullback, and it would not surprise me to serve as a future level of support should we get a little bit of a pullback right in that area there. Okay, so the Dow is also very strong. The Russell is the only one that is really bringing up the rear, and the one that is showing the strongest on a weekly chart is the NASDAQ. Now, if we look at the NASDAQ composite, you're going to see here, I've got the dot-com bubble in here. Again, this is a weekly chart. This is back in year 2000, February 2000, before the markets really came unglued for NASDAQ and technology stocks. Then you can see right in this area here, right around March 2009, when the markets really started moving back up again, how we've quickly regained over these years, and we're approaching, we are fast approaching the all-time highs in NASDAQ. And a lot of people thought it would take a long time to do that. And, you know, that's what it's doing right here. Again, this is right in that area there in the year 2000, right? And now we're sitting right here, going to be going into 2015. So that would be obviously 15 years, you know, from point to point like this. So a lot of people thought it would take longer than that to come back up. But again, we got that bearish divergence that just is so pernicious as we're making these new highs. And you can see this channel here, again, like the other indices, we've stayed inside this channel fairly tightly. We're now outside of this channel on the northern side of the border. I suspect we're going to have a pullback into this channel. We've got this bearish divergence, so I don't know if this pullback is going to occur before the end of the year or Q1 or Q2, but I suspect over the next 90 days we need to watch another. I think the markets are susceptible to the similar pullback that we had in October. Right now we're in a buy on the dip mentality, meaning any pullback in the market is picked up and bought. The potential triggers, it could be anything for a trigger to give us a further pullback here. But, you know, obviously the most likely scenario would be further tightening by the Feds, and the economy gets stronger, and then that tightening will beget a little bit of a pullback and some profit taking. Now, if we come back to the SPX again, you know, and I showed you the weekly chart here. You can see this, and let's just zoom in just a little bit, put a little bit more perspective, bring it a little bit scale on this. You can see, I mean, we're riding that upper boundary there, and we can ride it for quite some time. I believe we're going to be susceptible to a downside move. If we come into the daily chart, let's just zoom in just a little bit to give you guys a little bit closer perspective on this. You can see right here, we hit that high of 2079.47 on Friday, and we're at the upper boundary of this chart. We've got just a very small hint of a bearish divergence on this daily chart here, just very small. So that would mean, you know, minor potential pullback, nothing, anything major. We'll probably have buyers step back in again and buy on a dip. But you can see we've got a high here, we've got a higher high there, and there was that just a minor pullback that I had talked about that showed up on the 120-minute chart, which I'll show you in a minute. So now this would suggest we've got a little bit of a divergence going on right there. Again, as we say in our group, it is called a BED or a bed. That would suggest a little bit of a pullback. The support area would be that support zone right in this area here, which is around 1245 area, 1242, 1245. But this is what I'm looking at for the near term. Okay, just a little bit of weakness. We may have another run up, another takeout, and make another new high, and then weakness settles in. But that would be kind of what I'm seeing on this daily chart right here. Nothing major, just a little bit of a dip in the markets here. If we come in and look at a daily or a 2-hour chart, which is a good pairing with the daily, on the SPX, you're going to see at this point right here, when I zoom in just a little bit here, on this daily, or 2-hour rather, you're going to see on this 2-hour chart, you can see on the 120, the bearish divergence shows up just a little bit more on the RSI. Now, you can use a number of different indicators to give you bearish divergence. In this example this weekend, I'm just using the RSI because I know a lot of people are comfortable with using it. But you can see that we've had this very tight channel run up here, which, you know, this is our longer term upslope and trend line right there, okay? And that was the vector of that. You can see this one right there, which is about a year old, a little bit more than a year old, upslope and trend line right there. And the vector there is just a little bit steeper. And then we've got this vector right there that's very steep. So, you know, generally when things start, go from one steepness level to another like that, then that tells me we're getting towards a little bit of a peak and a little bit of a pullback. Again, a little bit more egregious down here. We've got, as I said, we've got a bearish divergence. So we've got a bearish divergence, a minor one on the daily, a little bit bigger one on the 2-hour, and a longer term one on the weekly. So this suggests, while we do see some upside potential, there's going to be downside risks. Now, and what we're going to do is in our group, we're going to trade this and take advantage of this. Now, for our group for Sunday night session, I'm going to go into some more detail on my strangles and some of the things that I'm doing and taking advantage of with the SPX. And I'll show you guys how to trade that if you do not have portfolio margin or you've got a smaller account size. We can go look at the spiders as well. For those of you that are non-members watching this video, I highly encourage you to come on in and sign up. We've grown. We're doubling our membership several times a year just due to we seem to be on the right side of the market. I'm on the right side of the market with these calls here, and we've been that way since 2009. Actually 2008, we played it to the downside, now back up again. So I highly encourage you to come in and check us out. So these are the key indicators that I'm seeing here. If we come into the Russell, and let's go back to the daily again, because the Russell again is kind of a weather vane for us. And again, we're going to look at the Russell index, not the futures. And if we zoom in a little bit on the rut right here, you can see, let's just get the screen set up here. You can see right here that the rut has been very volatile. I mean, every dip has been bought, but then it's been sold off again. So we're coming up to a couple of key areas right here. We need to be able to penetrate this 1183 to 1185 zone. Right around 1190. We need to get into the 1200 area to see any further appreciation. And I'm just not sure if the Russell's going to be able to do that. We're going to look at this and see, but I'm really watching this thing very closely. I don't see any. I saw a little bit of a bearish divergence coming into this Elliott Wave 3 peak, which would suggest a pullback to a 4 and then a move back up to a 5 again. But I'm not really sure right now. It looks like it's just mostly chop. I want to see us take out this 1191 peak right here, come up to 1200, and then you can see the next support level or resistance level at 1213 for the rut right here. So right now I'm neutral on the rut from a timing perspective. If we come into the 2-hour to see if we can get a better sense of direction, our short-term bias as we go into early next week. You can see right here, the story is similarly mixed. You can see that we finished towards the on Friday. We finished towards the high for the day in the Russell. The Russell had a good day. In fact, the Russell outperformed. It was not quite 1% of the day for the rut. It was about 0.8%. It outperformed the E-minis, NASDAQ, and the Dow. The Russell was the top performing index, which is really good. We want to see that. But I want to see this thing carry forth here. If it starts to roll back over again, then we got to be careful with the other indices. So again, the key level we want to watch, we want to see the rut take out 1191 for early next week. If it does not, if it starts to falter and roll over, then the downside move, the support for us is going to be around 1153. That's kind of what we're looking at for the downside. So 1191, 1153 are kind of the areas I'm looking at. Now, if we look at bonds, very interesting. Let's come back and let's look at the weekly chart on bonds. And you're going to see on the weekly chart on bonds, the entire year, 2014, has been a great year for bonds. A lot of bond traders have gotten it wrong, dramatically wrong. With the coming into stimulus, just about everybody and their uncle was talking about bonds going to be going down and interest rates are going to be going up. This right there is the first week in January, and you can see this channel bounded by the slightly shaded blue area represents, the trajectory of bonds for the entire year of 2014. Bonds has been a great performer. I think right in this area here, as I said before, probably up in this area here, shorts are going to start to come in and drive it back down to the lower part of this channel again. Should we have a larger pullback in Q1, you're going to see bonds come back up and revisit this area here. But I think the life of bonds is limited in this up channel. I think we're going to break it and come down and test either the 50 EMA or the 200 EMA as we get into next year. Maybe not in Q1. It could happen, but we want to watch this and see. Now, we also had a little bit of a bearish divergence on bonds on this weekly chart, and that would suggest some weakness longer term. I'm looking at possible trades in bonds. We got to be careful because we have the FOMC meeting coming up week after next, and as you guys know, especially if you trade bonds, FOMC meetings, the monthly meetings, the Tuesday, Wednesday, bonds move one or two handles very, very easily, and if you're on the wrong side of that, it's a painful experience. Now, so there are a number of different ways to play bonds. You can play bond futures, which is what we're looking at right here, or you can play TLT. TLT is an ETF of a 20-year hypothetical note and interest rate note or bond, and you can play this. It goes in the exact same directions as bonds. So TLT is like a proxy for bonds, all right, if you look at the bond futures. So either one of them. Now, the other way to play it is TBT. TBT is a proxy for interest rates, all right? And remember, bonds move in the opposite direction of interest rates. Therefore, TLT moves in the opposite direction of TBT. So for those of you that think interest rates in the next 2 or 3 years are going to go up, you want to be playing the long side of TBT. So you're going to be long here, or you're going to be playing the short side of TLT. So there's a number of different ways to play this environment. If you're a futures trader, you can play on the bond side. If you're a equity trader, you can play on the equity side with TLT or TBT. Either way you play it, these are going to be some very, very interesting and fun trades, and I think there's going to be some really good money to be made in that. So our members, stand by for 2015. It's going to be a fun run. The other thing that's very interesting here that is just coming up here is, let's look at currencies. Let's start off with the euro. As I said with the euro, it has gotten trashed. The ECB did not do their stimulus. I had talked about that, and I said the odds favor them not to do it. This is a weekly chart of the euro. And you can see here, if we step out, you can see just how the euro has performed, just like this. We're coming down to the bottom cycle of the euro down here. You can see how it's honored and has not been able to penetrate this upside, and then this last move, and then it's just cratered. And now it's waiting for the ECB to do something. You can see the generally when the euro falls, as you can see, all of these down movements are rather steep. All of these movements are fun to trade, guys. If you're on the right side of the trade here with the euro, you're smiling and you're taking cash to the bank. And remember, just like on bonds with TLT or TBT for interest rates, you can do the same thing with the euro. You can trade the euro futures. You can trade Forex. The U.S. dollar euro is a good combo. Or you can trade FXE, which is the ETF equivalent of the euro. I personally like euro futures. I think it's the most pure form of trading the euro. But again, look at this weekly chart. I mean, we are just in this tight death spiral, and it started since June, and this is where we're sitting. Now, if we come into the daily, and the reason why it's in this death spiral is now word hit the street on Friday from Bloomberg, and I think another source, that the ECB's already prepping for a very strong stimulus package in January's meeting. So that's going to further add to the weakness in the euro. And you can see we're in a 3-4-5 pattern here on this euro, and we're staying fairly tightly knit here. But you can see the 5 is projected down to 116. If the euro comes out with that strong stimulus, I mean the ECB, euro is going to be down to 116. So for those of you members in our group that have been trading it to the downside, great. That's kind of what we've been suggesting. Very good trade. I'd stay with the trade because the odds favor further downside in the euro. If we look at the pound, and we come back to the weekly chart of the pound, you can see right here we played the pound to the upside. We had this nice upside move, but then look at this downside move here. Very strong. On the weekly chart, you know, we're oversold. But the pound is going to react to the euro and the ECB because the pound from Great Britain gets almost all of their trade, our exports, into the ECB. That's the bulk of their exports. And when the ECB craters, it tends to have a backwash effects on the British pound. You can see this movement right here on this weekly chart. So if we come back into a daily, we're going to play the pound as well. But I'm going to be more apt to play the pound to the upside than the downside, but not right now. You can see right here we've been in this tight containment pattern. The odds favor further downside movement in the pound, and you can see right here on Friday, very, very bad down day. Why? We had very strong numbers coming out of the U.S. Money is coming into the U.S. It's keeping interest rates artificially low, bonds artificially high. Money's coming in from the ECB, coming in from Great Britain, coming in from Japan. Money is buying a lot of bonds and U.S. equities, and they buy it with U.S. dollars, which keeps the dollar very strong. And speaking of the dollar, if we come in here and we take a look at the U.S. dollar here, here's the dollar futures. Again, on this daily chart, you can see we had this tight consolidation pattern for almost 1 month, and then bam, we broke out. The odds favor to break to the upside, and as I told our members, whichever side we break, we're going to trade it, but I favor trading the upside, and this is exactly what we did. We're now hitting some resistance in the dollar right here, so we may have some momentary pullback, but if the ECB comes out with more stimulus, you're going to see the dollar continue up. If we come on a weekly chart, you know, how high can the dollar go? Well, we're not even there yet, folks. I mean, if you can see what the dollar is doing, I've been in and out of the dollar several times, so have our members. You can see this is a key. It's going to be a key resistance point here. We may stay there a little bit like we stayed at that other point I showed you in the dollar for a month, probably until we get the ECB action. But look at how high the dollar can go. Now this was back in 2000 when we had the dot-com bubble, but you can just see we've got a long way to go. I mean, we can just keep right on moving up well over 100 if the U.S. economy continues to run and expand, and the ECB in Great Britain and Japan continue to falter, and Japan or China continues to overstimulate their economy as well. So we've got a lot of opportunities here. On the weekly chart, you can see the oversold nature, the overbought nature in the dollar. So there's a little bit of a downturn or downside risk, but we're going to use any downside in the U.S. dollar as an opportunity to buy. Okay, so anyway, this is kind of where we're sitting right now in the markets as we jump into this next week into December. For our members, I will see you guys this Sunday night for our Secret Trader session, Sunday night session. For our non-members, I'd love to see you come on in and join our group. We're having a lot of fun, and I would love to have some new members come into our daily chat room. Remember, we also do sessions on Tuesday mornings and Thursday mornings before the market opens, and we also do it Sunday night. So, and we've got a lot of education out there that I think will be very helpful for everybody. All right, everybody, have a great day, great weekend, and I will see our members tomorrow night. Ciao, everyone.